Hello and welcome to this weekly edition of the Video Market Analysis in coordination with Orbex.com. There were two main events that we were also tracking or watching last week, which both had a notable impact on the market, starting with the ECB decision, followed by the US jobs report, which both also sent mixed signal to the market. Beginning with the US or the ECB, or the bank basically kept the current policy unchanged in the previous meeting, but Mario Draghi was also clear about two things. The first one is that the tapering is coming sooner or later, and it is likely to start as early as April and likely to end by the end of this year, which is of course a positive factor for the euro. However, he also said that the ECB will be ready to adjust the current policy or the current QE program depending on the future economic outcome, whether to increase it or even decrease it. But in short, this means that it's all about the economic reasons. This is exactly, of course, what happened with the Federal Reserve, or what the Federal Reserve did. However, the difference here is the ECB is more transparent. Moreover, the ECB noted that they also discussed raising rates if needed before the end of the current QE. Such signal for me would eliminate even the idea or the estimates for a possible crash or a sharp decline in the euro anytime soon against the US dollar, and I would not be even looking for a decline to the parity with the US dollar anytime soon. In fact, I believe that the euro is likely to gain some strength right before the ECB announced the official tapering. Therefore, I would love to see also, or to start building some long position on the euro on the medium term. But first, I would also like to see some correction to the downside before doing so. As for the US jobs report, it also gave us mixed signal. The unemployment rate ticked lower as well as expected, while the economy added more than 220,000 new jobs. However, the US dollar declined across the board. And here, if you're asking again why this happened, we said this many times in our videos and our also reports, it is all about the wages growth. The year over year showed a stabilization for the second month in a row, while the month over month increased by only 0.2% despite the fact that the estimates were to rise by 0.4%. Yet, the Fed Fund futures, of course, is still pricing in a 100% chance for a rate hike in March, which I believe that might go wrong at some point, or the Federal Reserve is likely to give us what we call it a dovish hike. But the most interesting part here is that the US dollar index remained within our plan, closing last week's trading below the 102 resistance area, the one that we basically is going to talk about it later. But before going into our next subject, the White House has now a different view. Before entering the White House, Donald Trump had believed that the US jobs report used to be phony and unreal. But when Friday's numbers were out, the White House also said that they are very real now, and they were even laughing during the press conference, which makes us also wonder why and how he changed his idea toward the US jobs report in a very short period of time. But at the same time, will he change his mind regarding Janet Yellen and the Federal Reserve anytime soon? Only time will tell. Anyway, let's end this here, and let's have a look also on let's have a look at our technical charts. Beginning with the US dollar index, and as we said in the past few weeks, we were watching again the dollar index for the past few weeks, trying to build a potential head and shoulder formation, which is basically we're talking about the left shoulder here, and we have the head around the 103, 103.50, and we have the 102, 101.80 as the right shoulder or the potential right shoulder. So far, there's no confirmation, but last week especially, and this is again we're talking about the daily chart here, but last week the daily candle, the final day of the week because of the US jobs report, showed a bearish engulfing candle, which might be the first indication of another leg lower. However, we still need to break below the 50-day moving average and also the 100-day moving average all the way here, and the neckline is still far away. But for the time being, we're still watching the US dollar for another leg lower. The technical indicators are pointing lower, most of it. Stochastic indicators, and most importantly, we have the RSI is pointing lower. So I think that there will be more downside ahead, but we need to keep an eye on the those two moving averages here, the 100 and the 50-day, and of course the psychological support, which is the 100. I would believe any short position on the dollar index with a stop above the 102.50 or around 102.50 should be very safe to keep an eye on in the next few days. Going forward to our also weekly wrap up about the FX market, beginning with the New Zealand dollar, which continued also to trade within our plan. This is for the second week. We have two consecutive weeks of declines. We broke through the 50-week moving average, the one we talked about last week. Technical indicator is still lower. We had another leg lower last week, all the way almost to 0.69. We have the 100-day moving average, which is basically 100-week moving average that should keep an eye on in the next few days, because that might be the end of the decline. We might see some sort of a retracement, but at the same time, we have an important trend line here to keep an eye on in the next also few days, because this was a clear break in the past few weeks. And whether you want to take it from here, or even if you want to add another one here, they both shows you like there's a clear break below those two trend lines, which need to keep an eye on. At the same time, we still have this support area here, which is around also 68.60s, need to keep an eye on, in addition to the 100-day moving average. This is a very important level to keep an eye on in the next few days, because it's going to be significant. And I think that we might see a bounce at the beginning of the week, all the way back to almost the 70 before the downside continues. Especially that technical indicators are also lower on most time frames. The Aussie has also almost the same story as the Kiwi, definitely, but here we still have another. The technical indicators are pointing lower more than in the Kiwi. At the same time, there's still more room for more downside in stochastic indicators. We still have the 50-week moving average that held perfectly last week, 75, and rebound from it, but we still believe there's more downside ahead, especially that the RBA last week actually gave us also mixed signals, but still worried about a strong Aussie, saying that it will complicate the economic transition. So I still believe with more downside ahead in the next few days, but keep an eye again on, or at least for this week, keep an eye on the 74.40s, which is the 100-week moving average, is likely to hold in the next or during the days ahead. Going into the euro, which basically made a very important upside, a very important spike, all the way, and starting from exactly the 61.8, the one that we talked about last week. We had a test for it for two consecutive days. Actually, that was 2 weeks ago, and then this last week, and then we had the spike on Friday. And the good thing here is that we broke above the 50-day moving average and the 100-day moving average on Friday. Technical indicators are pointing out to the upside, which keeps the chances higher for more gains. Actually, 107 is still another obstacle to keep an eye on in the next few days, but I still believe in the euro, especially after what we said about the ECB and what they're thinking to do. Tapering is very good for the euro. At the same time, discussing to raise rates by the ECB is also before this is what the ECB said, that they might be able to raise rates before the end of the QE. So this might happen also this year, especially if inflation figures continue to rise, as we're seeing right now already. So the euro is still potential, still more upside ahead. I still believe 107, 108 is a very good place, or is a very good levels to watch in the next few days. That will be possible. Dollar yen, despite the fact that last week it continued to rise, but the daily chart on the dollar yen is basically showed us a very significant candlesticks here on a Friday. A bear shooting star on the daily chart. This is also combined with the technical indicators is heavily overbought and a little bit pointing to the downside. So I still believe this is another chance, or another indication that the dollar index might not hold that much. So that's why we're still looking for more downside in the US dollar across the board. At least we might see, or at least we might retest the 114 in the next few days, and a break through that level would lead us to another leg lower, possibly toward 113.50. Going into the British pound, also it continues to weaken, despite the fact that this is also the daily chart, and despite the jobs report, and despite the fact that the dollar index declined across the board. The British pound was almost the weakest performer on the week, and this is because, again, as I said before, because of the Brexit uncertainty and the continuous dialogues regarding the Brexit, and this is still likely to keep on going in the next few days. However, we need some sort of a spike, or some sort of a retracement to the upside. The good thing is that we had almost two doji candles on 2 days. This is basically one of the reasons why I would be looking for a very short term long position, especially as long as it holds above the 2140s, 2120s, just like what happened here back in January. So I still believe there's a possibility for more downside, but we need more or another retracing to the upside before we jump in, especially if the technical indicators are heavily oversold. Finally, looking gold and silver, as we said last week, the gold and silver. This is silver. Silver continued to trade all the way lower and broke through all of the moving averages, but at the same time on the weekly chart, they're still bullish on most of the time frames. But however, here we are entering the buy zone, which is the 50 and the 61% Fibonacci from the recent rally that we've seen since almost mid-December. I guess it's 19th of December, 15th of December, all the way to the top of February. Now we had the retracement. As long as silver trades above the 16 level, I would still be looking for another long position, or at least another spike, another spike in the next few days. Especially the technical indicators also heavily oversold. Finally, we'll look at the gold, which basically made also another leg lower. As we said last week, the 200-day moving average was very significant on gold. Right now we are seeing some sort of another downside. We broke through most of the moving averages, all of the key moving averages, but at the same time they both have the same story. But right now we're almost reaching the 50 and the 61.8, but don't forget that the 1200 level is very significant for gold. It might start bouncing from here, but the safest place to buy it's between the 50% Fibonacci, which is right now trading around 1193, and also we have another level which is 61.8, which basically stands at 1176. We might not see it as that much there, but I still believe there's more upside ahead, especially with a bullish shooting star on gold on the daily chart. So these are the charts that we would like to talk about this week. We're not looking at the US equities because they're continuing to rise. It's just going crazy for the time being. I would love to stay away and keep trading with currencies and commodities for the time being. Again, thank you for watching. Stay tuned also during this week, as we will be publishing the daily reports over the coming days to discuss the key events and the economic releases, which are likely to have a notable impact on the markets, and we will also explain some examples and scenarios on how to trade these events and these news. If you have, of course, any questions or comments, please leave them below. Thank you for watching. Have a good one.